Robert, let's start today with the producer price index. It heated up in October, but you say that's bringing about concerns of inflation. Can you expand on that?
Well, yes, Susan, we're certainly concerned about the increase in labor costs, the increase in capital costs, the potential from tariffs to boost prices up. But this PPI report from October was hot for a completely different reason and a counterintuitive one, because we know that oil prices have been falling the last several weeks, but in fact, in late September and early October, they were increasing. And so the monthly average crude oil prices for October were fairly warm, and those energy prices have boosted the headline PPI numbers. Now, I expect that effect to reverse when we get the November numbers next month, because as we know, that oil prices have fallen substantially over the past couple of weeks.
Robert, let's move on to the non-manufacturing index. The numbers are still strong, but in your report today, you note that anecdotal comments, they remain that there is still some uncertainty about international trade.
Yes, Susan, I think the ISM non-manufacturing index is consistent with a very strong economy. It came down a little bit, still above 60 and change, and that's a nice reading. But when you look through the anecdotal comments, fair to say that many businesses remain very concerned about trade, even though the U.S.-Mexico-Canada deal has been formulated, hasn't been ratified yet, but been formulated. There's still a great deal of concern out there about trade relative to China. And the president has indicated he will meet Xi Jinping from China at the end of this month. We still don't know what's going on behind the scenes with that, but businesses remain very concerned about the possibility of more tariffs with China, or hopefully the hope that current tariffs will be reduced.
Moving on to mortgages, we've talked about housing quite a bit lately. Mortgage apps fell again. What do you make of the housing market at this point?
Yeah, it's a soft market, Susan. It's definitely cooling down. When you look at year-over-year price changes, we're now below 6%, 5.8 or so on the year-over-year numbers. Home sales, both existing and new home sales, are declining, as well as home construction. And that shows up in the weekly mortgage apps numbers. When we look at applications for purchase, they're down now on a year-over-year basis, 3.4% down on a 4-week moving average calculation. So basically all the housing numbers are showing that housing markets are starting to cool down a little bit. And I think that is consistent with the rising mortgage rates, now solidly above 5%.
Robert, let's move on to the Fed meeting this week. What do we need to know about what happened?
Yes, Susan, that was pretty much a non-event as widely expected. The Fed did not raise the benchmark Fed funds rate at the November meeting this week, and all expectations are continuing for the next rate hike in December, mid-December, to get another 25 basis point hike. My expectation is that the Fed maintains its gradual approach. I've been calling it gradualism, meaning a 25 basis point rate hike every other meeting. So we get one in December, we'll skip January, next one comes in March. And I expect them to maintain that cadence at least through June of next year. When we get into the second half of next year, things may change. We may see a break out of that. But I think for at least the next, say, 9 months, gradualism holds with the Fed.